Have you ever stopped to think that most people spend their entire lives working, but never understand the basic concepts that truly make money grow? Many believe the problem is not earning enough, but the truth is that lack of financial knowledge costs much more than you imagine. Today, we are going to show you the fundamentals that everyone should learn in school. Simple concepts, but that can completely change your financial future. If you don't master these points, you will remain trapped in the same cycle. Earn, spend, and never progress. And I want to know from you, when was the first time you realized you needed to learn about money? Was it when you went into debt, when you started earning more, or when you saw someone close struggle financially? Leave your experience in the comments because we will respond and exchange ideas with you. Now let's start. 1. What is real money? Many people believe that having a good salary already means being rich. But the truth is, real money is not just about what you earn, but how you manage, multiply, and maintain that money over time. Income, wealth, and cash flow. Income is what comes in monthly. Your salary, bonuses, commissions, rental income, dividends, etc. Wealth is what you have built. House, car, investments, savings, real estate, business. It is the accumulation of what you have already achieved. Cash flow is the movement. How much comes in and how much goes out. It shows whether you can maintain a sustainable standard of living in practice or if you are spending more than you should. The illusion of earning well, earning $20,000 per month but spending $19,500 is not wealth. It's living on a tightrope. A salary cut, dismissal, or an emergency can destroy your stability in days. On the other hand, a person who earns $5,000 but organizes their expenses, invests every month, and builds wealth is truly laying the foundations for financial freedom. Real money. Real money is not ostentation. It is not showing off the latest car or international trip. It is having peace of mind to make decisions without panic. It is opening your fridge, looking at your bills, and knowing that if something goes wrong tomorrow, you are protected. It is the combination of a healthy income that is not dependent on a single source, positive cash flow with surplus every month, and growing wealth where your assets work for you. This is the tripod that transforms income into wealth. And now I want to know from you, do you believe you are building real money or just working to maintain a lifestyle? Comment below. 2. Simple interest versus compound interest. When it comes to finances, few things are as powerful and, at the same time, as dangerous as interest. They can be your greatest ally in building wealth or your worst enemy when it comes to debt. The difference lies in how you position yourself regarding them. What is simple interest? In simple interest, the calculation is done only on the initial amount invested or borrowed, called the principal. This means that if you invest $1,000 at 10% per year at the end of each year, you always receive $100 in earnings. Linear, predictable, no surprises, good for learning, but not very efficient for multiplying money in the long term. What is compound interest? Compound interest works exponentially. Here, the earnings of one period are added to the principal, and in the next period, interest is calculated on this new amount. In the same example of $1,000 at 10% per year, in the first year, you will earn $100. In the second year, the 10% will no longer be on $1,000, but on $1,000 plus 10% of $1,000, which is $101,100, resulting in $1,210. This positive snowball continues to grow, accelerating more and more. It is the famous interest on interest that Albert Einstein called the most powerful force in the universe. The dark side of compound interest is that the same logic works against you. Credit card debt, overdrafts, and abusive personal loans use compound interest. A small delay can turn into an unpayable snowball. What seemed like a controllable debt grows month by month until it suffocates your income. Interest is neither good nor bad by itself. It is a tool. The question is, will you use it in your favor or let it work against you? By investing, you plant today to harvest increasingly greater fruits in the future. In debt, you become a hostage of a cycle that steals more and more from your present. And now I want to know from you, do you feel that interest today is working as your ally or your enemy? 3. Inflation and purchasing power. Have you noticed that with the same money that could buy a lot of things a few years ago, today it buys much less? This is the direct effect of inflation, the continuous and generalized rise of prices over time. In other words, money loses value because each year you need more to buy the exact same products or services. Why does money lose value? Inflation happens for several reasons: increased production costs, growing demand, economic instability, and excessive money printing by the government. In the end, all these factors result in the same consequence. Your money's purchasing power decreases. Imagine that in 2010, you went to the supermarket with 100 and came back with a full cart. Today, the same 100 probably doesn't even fill half. This means that if you keep money idle without earning, it is silently devaluing, like melting in your hands. The impact of inflation on your life. This phenomenon directly affects your daily life and especially your future. If you don't invest, you lose money every year, even without realizing it. Keeping 10,000 under the mattress, for example, may seem safe, but in 10 years, this amount will have much less purchasing power. Now consider, the more time passes, the harder it becomes to achieve big financial goals if you do not take action. Buying a house, funding children's education, taking a dream trip, or even ensuring a comfortable retirement, all of this can slip away if your money does not grow at least above inflation. The solution: investing. The good news is that there are investments specifically to protect and multiply your money against inflation. Treasury IPCA Plus, inflation-linked TDBS, funds, stocks, and even real estate can prevent your purchasing power from evaporating. The point is not just to invest, but to invest intelligently, choosing options that yield more than the rise in prices. Inflation is invisible, silent, but relentless. If you do nothing, it will erode the value of your years of work. But if you learn to invest, you can turn this threat into a boost to build wealth and financial freedom. And have you noticed in practice how inflation has affected your life? What did you buy 5 or 10 years ago that now costs much more? Share in the comments. 4. Emergency fund. Imagine you are living your life normally and suddenly an unexpected event occurs. The car breaks down, a medical expense arises, or even you lose your main source of income for a few months. What would you do? If you don't have an emergency fund, your first option will probably be to use a credit card or take a loan. And that's when the cycle that destroys many people's financial life begins: high interest, accumulated debt, and constant stress. An emergency fund is like a financial cushion that softens the fall during the hardest moments. It is money saved exclusively for unexpected situations, providing security and peace of mind. Having this cushion means sleeping peacefully, knowing that no matter what happens, you won't have to go into debt to survive. Where to put this money? Safety and liquidity come first. Unlike other types of investments, an emergency fund's goal is not high returns, but to be available quickly and safely when you need it. Therefore, the fundamental criteria are safety and liquidity. Liquidity means you can withdraw the money at any time without bureaucracy. Safety means your capital is not at risk of major losses, as could happen with stocks or more volatile investments. The most recommended options are the Select Treasury, considered the safest investment in the country as it is guaranteed by the National Treasury with daily liquidity and follows the basic interest rate. Daily liquidity CDBS offered by banks and brokers also allow withdrawals at any time, paying interest proportional to the days invested. DI funds or remunerated accounts. Some digital banks and brokers offer practical alternatives with returns close to the CDI. The important thing is not to leave this money in savings, as it earns little and often loses to inflation. Good debt versus bad debt. Many people grow up hearing that all debt is bad, but the truth is, it's not that simple. Not all debt has to be a burden or a problem. In some cases, it can be a lever for growth. The secret is understanding the difference between what we call good debt and bad debt. Bad debt is money leaving your pocket without bringing any return. It is usually linked to impulse consumption or the purchase of items that quickly lose value. It's when you finance something that loses value or doesn't generate any form of income. Practical example, paying for a top-of-the-line smartphone in 24 installments on your credit card just because everyone has one. Taking a loan to travel, enjoy a party, or buy branded clothes. The problem is that in the end, you not only spend more than you should, but also remain burdened by interest, which can turn a simple purchase into a snowball of debt. What is good debt? Good debt is different. It works like an investment. It is money you borrow to put into something that can bring a return, whether financial or in long-term quality of life. Practical examples. Taking a loan to start a business that will generate income. Taking a loan to pay for a postgraduate course, which increases your chances of getting a better job or higher salary. Financing a property that can be rented, generating passive income every month. In other words, good debt pays for itself because it opens the path to growth, income generation, or future appreciation. How to differentiate in practice. Before taking on any debt, ask yourself, will this put money in my pocket or take it out? Will this expense bring future returns or just immediate pleasure? Can I pay this debt without compromising my budget? If the answer is it will generate a return, then you may have good debt. But if it's only to maintain appearances, satisfy a temporary desire, or spend more than you earn, it's better to avoid it. The difference between good and bad debt is mindset. Bad debt drains your income, while good debt can be a ladder that accelerates your goals. Have you ever fallen into the trap of bad debt or managed to use good debt to grow? Share in the comments. Your answer could help someone going through the same situation now. 6. Assets versus liabilities. Many people hear about assets and liabilities, but few truly understand the impact these concepts have on your pocket and especially on your financial future. Simply put, an asset is anything that puts money in your pocket. A liability is anything that takes money out of your pocket. It may seem obvious, but in practice it's not, because we often confuse consumption with investment. Buying a car, for example, may seem like an investment. After all, it's a good. But unless that car is being used to generate income, such as for a rideshare driver, it is a liability because it requires maintenance, fuel, taxes, and depreciates. Now think of a rental property. Unlike the house you live in, this property can be an asset because it generates monthly income that goes into your pocket. Similarly, dividend-paying stocks, a business that generates profits, or even fixed income investments that pay interest are assets. They work for you instead of draining your money. The problem of confusion, the big mistake is believing that buying consumer goods, latest smartphones, expensive clothes, a new car every year, is the same as investing in yourself or increasing wealth. In reality, many of these choices are disguised liabilities that drain your budget and prevent wealth building. That's why so many people work hard, earn relatively well, but always feel tight financially. Because in the end, it's not how much you earn, but how much remains after paying all liabilities. The path to financial freedom. Those who want to build wealth need to change their mindset. Prioritize assets that generate continuous income, control liabilities, and consume consciously. Understand that every real spent on something that doesn't bring a return is one real less to build independence. Ultimately, the key question is, does what I'm buying put money in my pocket or take it out? Have you ever reflected on what is truly an asset and what is a liability in your life? Share in the comments the biggest financial confusion you've ever had thinking it was an investment, but it was just consumption. 7. Diversification. Imagine that you have only one source of income or a single investment. If something goes wrong with it, whether an economic crisis, a company going bankrupt, or even a personal unforeseen event, suddenly all your wealth could be at risk. It's like walking on a tightrope without a safety net. This is exactly where the importance of diversification comes in. Instead of concentrating everything in a single asset or sector, you distribute your resources across different investment classes, such as fixed income, stocks, real estate funds, gold, dollar, and even your own businesses. This movement doesn't just aim to seek higher returns, but mainly to reduce risks. When you diversify, you create intelligent balance. If one area is not doing well, another can generate gains and offset losses. Think of an investment portfolio like a football team. Just because the striker missed a goal doesn't mean the team lost the game. The other players are there to balance the result. In addition, diversification increases your opportunities. Each asset class reacts differently to economic changes. While inflation may hurt some investments, it may benefit others. While the stock market falls, fixed income may become more attractive. Having this combination ensures that you don't depend on a single variable to succeed. Now I ask you, have you ever checked your investment portfolio and reflected if you're putting all your eggs in one basket? Or are you creating a solid strategy, distributing your wealth intelligently to achieve more security and financial peace? Leave in the comments how you have diversified your investments today. Do you feel protected, or are you still betting on a single option? 8. Budgeting and expense control. Many people feel that money simply disappears over the month. The salary comes in, bills are paid, small expenses appear, and before you know it, the money is gone without knowing where it went. This is precisely where the power of a simple personal budget comes in. It is not a prison, but a map that shows where your money should go instead of letting it get lost. A budget allows clarity and control. When you know exactly how much you can spend in each area of your life, you avoid unnecessary debt and build a healthier relationship with money. The good news is that budgeting doesn't need to be complicated, full of spreadsheets with difficult formulas. In practice, a simple method is enough to transform your financial life. The 50-30-20 method. One of the easiest methods to apply daily is 50-30-20. It divides your net income into three main blocks. 50% for necessities, all essential things that cannot be ignored, such as rent, utilities, transport, and basic food. This portion ensures your survival and minimum quality of life. 30% for wants, things that bring pleasure and fun but aren't essential, such as travel, restaurants, streaming subscriptions, new clothes, hobbies. Having this planned space prevents impulsive or guilty spending. 20% for the future, investments, emergency funds, and debt repayment. This is the part that really builds financial freedom because it's where money starts working for you. Why does this method work? Because it is simple and flexible. You don't need to track every coffee or every single reel. It creates clear, easy-to-follow limits. If you know you have 30% of your salary for leisure, you can enjoy a trip or dinner without guilt. At the same time, it ensures you are always saving 20% for the future. Over the years, this habit makes a difference between those constantly running to pay bills and those achieving financial peace. A budget is not about earning more, but using what you already earn better. Even if your income is modest today, applying the 50-30-20 method gives clarity on where to cut, improve, and build wealth. Now, I want to hear from you. Have you ever tried organizing your money with a budgeting method? If yes, did it work or did you give up halfway? Share your experience in the comments. Your answer may inspire someone who is starting. 9. The importance of investing. Many people confuse saving with investing, but they are two very different financial actions. Saving means keeping money aside, usually in a savings account or even under a mattress, with the idea of accumulating. Investing means putting that money to work, seeking growth in the medium and long term. Imagine you save $10,000 in a savings account, which earns just over 0.5% per month. Now compare it with investing in an asset that can historically yield 8% per year or more. In a few years, the difference is huge. This is called opportunity cost. Every idle reel is a reel that stops generating returns. Furthermore, by saving, you just keep money aside without protecting yourself from a silent enemy: inflation. If your money doesn't grow above inflation, you are losing purchasing power, even if your bank balance stays the same. Have you noticed that 100 today doesn't buy the same as a few years ago? This is living proof that saving alone is not enough. Investing, on the other hand, is like planting seeds. At first, results seem small, but over time, compound interest and the natural growth of investments make the tree grow. Those who start early reap much more, because time is the investor's greatest ally. Another important point is that investing is not a luxury for those who already have money. On the contrary, it is a necessity for those who want to build wealth, realize dreams, and have peace of mind in the future. What differentiates financially successful people is not how much they earn, but how much they can multiply what they earn. So here's the reflection. Are you just saving, or are you already investing? If you continue leaving your money idle, how much will you lose in the coming years? Comment: have you already started investing, or are you still just saving? I want to know how you've been handling this and your biggest questions along the way. 10. Continuous financial education. Financial education is not a subject you learn once, like a math formula or a manual. It is a continuous, dynamic, lifelong process. The world changes, the economy fluctuates, new tools emerge, and even how we handle money evolves as we go through life stages. Therefore, thinking, "I know enough," is one of the biggest mistakes anyone can make in their financial journey, because this learning never ends. Money is involved in every decision we make, from the coffee you buy in the morning to choosing where to invest your retirement. Each life stage brings new challenges. When you are young, the focus may be on learning to save. In adulthood, the need arises to invest and grow wealth. Later, priorities may shift to succession planning or ensuring family security. Furthermore, the economic environment changes. Inflation, new financial technologies, tax law changes, cryptocurrencies, new investment modalities. All this requires constant updating. The impact of small decisions. Often we think great financial achievements come from a single strategic move, but the reality is different. Power is in small daily decisions. Choosing to make coffee at home instead of buying it outside. Paying off a debt instead of taking a new installment purchase. Saving 10 per day in a simple investment. These actions may seem insignificant today, but in the long term, they accumulate powerfully. It's like compound interest. Small choices repeated with discipline build a solid, peaceful future. What does this mean for you? Whether you are starting now or already have assets, the learning never ends. Each book read, each course, each conversation with knowledgeable people is an opportunity to expand your view and make better decisions. The secret is not perfection, but consistency, adjusting your course when needed, and humility to recognize there is always something new to learn. If you've made it this far, thank you. If you're not subscribed, please subscribe and turn on notifications to stay updated on the channel's content. See you in the next video.